Hi, I was asked by some readers to show my performance. So what I thought is to put it in presentation form. Of course, I'm going to show you some winning portfolios that we use and their performance. I guess what the point is, if you look at the performance of these portfolios very carefully, there is a lot to learn. At least I did. Because of regulations, I have to say that past performance does not guarantee future results. The performance data are as of the closing of April 20, unless otherwise noted. And the performance of these portfolios is reviewed in every issue of the Peter Duck portfolio, which is every other week. The most important technical model that we use to give us the technical direction of the market is the S&P 500 model. The importance is that protects us from taking large drawdowns like in 2009, like recently in 2020, and it keeps us low volatility like 2015-16. And the interesting pattern, of course, that has outperformed the market and by a pretty nice margin. Has its own volatility, has its own uncertainty, but is a solid model that has a good historical performance. This model has been reviewed in my books and is based on the S&P 500 using the 200-day moving average. In order to recognize the difference between the models that I'm going to show you in the next few slides, is important to understand the role of the business cycle in the design of these models. Again, this is our business cycle real-time graph. This is when the economy expands and faster growth, and this is beginning 2018 when the economy started slowing down, and as you can see, is still heading lower. Again, the basic idea is that the sectors, they call it cyclicals, that are very strong during this period are weak, underperform the market during this period. Here is where you want to be in defensive sectors and bonds. So the two types of investment profiles is from stronger growth and slower growth. Here you want to be defensive, and bonds, here cyclical stocks. Let's see how now I use these two concepts to design the portfolios, and quite frankly, they have an excellent performance record. This is the equity model portfolio, which is published in every issue of the Peter Duck portfolio, and this is the blue line. What we do here is select stocks that are cyclicals, they are strong performers during a strong phase of the business cycle. And beginning in 2018, what we have done is instead shifting the portfolio in more defensive sectors and bonds. Now we use bonds quite aggressively, and this is why the portfolio has outperformed the market, as you can see, by quite a substantial. As of May, the market is up 22, 23%, and this one 41, 42% since December 16, as of May 8, 2020. And again, the reason is of this, we have done this shift from aggressive portfolio, defensive portfolio, but using bonds quite aggressively, and actually they have performed. It could keep, as of this recording, they are still performing extremely well for us. This is an ETF portfolio and has been designed to be defensive. In other words, with ETFs that do well in the phase of the business cycle that is slowing down. Of course, the portfolio is bound to underperform because during the rapid growth of the business cycle, those defensive stocks are not going to perform well. I knew that. So that's why the portfolio, which is the blue line, is underperforming. However, the reason I did it, because I said I want to see what is their volatility. And in fact, out of the portfolios that I'm going to show you, this is the portfolio with the lowest volatility. See how smooth the performance is. In 2015, hardly moved. slowly here, didn't go through all this volatility here, doesn't go all this volatility down here. So it's a that's why I call it a defensive portfolio. Again, it's out of ETF that perform well during the slowing down phase of the business cycle. Then I asked myself, let's see what happens if I design a portfolio with the ETFs that perform well during the strong phase of the business cycle. Of course, one should expect that it's going to outperform the market. Why? Well, because the market always rises. So the time that the business cycle is rising is longer than when it's slowing down. Therefore, this portfolio has an advantage, and in fact, it did. One of the advantages that is doesn't go down as much, doesn't have the large drawdowns of the markets. It doesn't have the large drawdown of the market, and outperforms the market. What is the disadvantage relative to the previous one? Of course, you want more performance, but the price that you are paying now is bigger, higher volatility. But it's still, that's why I called it an aggressive portfolio. Then I asked myself, what happens if I add utilities to a diversified portfolio like the S&P 500? This is the ETF for the S&P 500. So I overweight an average portfolio with utilities. What happens? Well, this is the performance using always the time and selling rules, or using the 200-day moving average, by the way. Again, the performance is great. First of all, the drawdown is not as big as the market, outperforms the market by a wide margin. The volatility is quite low, and I think is an excellent portfolio. What is the lesson here? That if you want to reduce the volatility of your portfolio, try to overweight the investments in utilities. The next thing that I did is, okay, let's add to an average portfolio that, like SPY, who does well, particularly well, during this rising phase of the business cycle, I add a defensive portion to the portfolio that given by bonds, long-term bonds, treasuries. So what do I have is a portfolio doing well, particularly well during the strong phase of the business cycle. I overweight the portfolio in bonds, and I use the timing rule of the 200-day moving average. Again, this portfolio, has a superb performance. It doesn't have absolutely the drawdown of the market. It's much smoother, lower volatility rather than all these ups and downs. It just moves up. So the bond part of the portfolio is doing the job of smoothing it out, so to speak. And then here, of course, outperforms the market by a wide margin without going through this wrenching decline that we had in March 2020. So the lesson is, if you want to reduce the volatility of an average portfolio, try to overweight in bonds, and you will smooth the performance of the portfolio. Of course, the next step is, given that an average portfolio did so well with bonds and with utilities, then I said, well, what happens if I add bonds and utilities to an average portfolio as expressed by the ETF SPY? So I have an average portfolio that does well during the strong phase of the business cycle, and I overweighted in bonds and utilities to smooth out the performance, and using the timing rule of the 200-day moving average. Again, what I have is another excellent portfolio. Quite frankly, is superb. Not only doesn't go down as much as the market here, has very smooth performance, keeps outperforming the market. The market here collapsed in March 2020, and this portfolio is still way up there. So is an excellent way to add to a strong portfolio, add bonds and utilities to smooth out the performance during periods of sharp declines. The performance data of all these portfolios, including compound annual growth rate, standard deviation, largest drawdowns, worst year, and so on, all these statistics are published in every issue of the Peter Dack portfolio. Of course, I published 3 more books, Profiting in Bull or Bear Markets, which is available in several editions in Asia from McGraw-Hill Education. And then I have 2 books here, Easy Ways to Beat the Market with ETFs, Investing Wisely Easier Than You Think, where I explain the details on how these portfolios have been created and why they perform the way it has been discussed.